Hi everyone, and in this video we will talk about how that's exactly the stock market work. Okay, let's start. If the thought of investing in the stock market scares you, you are not alone. Individuals with very limited experience in stock investing are either terrified by horror stories of the average investor losing 50% of their portfolio value. For example, in the two bear markets that have already occurred in the millennium or are beguiled by hot tips that bear the promise of huge rewards by seldom pay off. It is not surprising then that pendulum of investments sentiment is said to swing between fear and greed. The reality is that investing in the stock market carries risk, but when approached in a disciplined manner, it is one of the most efficient ways to build up one's net worth. While the value of one's home typically account for most of the net worth of the average individual, most of the affluent and very rich generally have the majority of their wealth invested in stocks. In order to understand the mechanic of the stock markets, let's begin by developing into the definition of a stock and its different types. So, what is stock? A stock is financial instrument that represents ownership in a company or corporation and represents a proportionate claim on its assets, what it owns, and earnings, what it generates in profits. Stocks are also called shares or a company's equity. Stocks ownership implies that the shareholders own a slice of the company equal to the number of shares held as a proportion of the company total outstanding shares. For instance, an individual or entity that owns 100,000 shares of company which 1 million outstanding shares would have a 10% ownership stake in it. Most companies have outstanding shares that run into the millions or billions. So, about type of stocks. While there are two main types of stocks, common and preferred, the terms equities is synonymous with common shares as their combined market value and trading volume are many magnitudes larger than that of preferred shares. The main distinction between the two is that common shares usually carry voting rights that enable the common shareholder to have a say in corporate meetings, like the annual general meeting or AGM, where matters such as election to the board of directors or appointment of auditors are voted upon, while preferred shares generally do not have voting rights. Preferred shares are so named because preferred because 1 minute the preferred type of stocks. The main distinction between the two is common share usually carrying voting rights that enable the common shareholder to have a say in corporate meetings like the annual general meeting or AGM, where matters such as election to the board direction or appointment of auditors are voted upon, while preferred shares generally do not have voting rights. Preferred shares are so named because preferred shareholders have priority over common shareholders to receive dividends as well as asset in the event a liquidation. Common stocks can be further classified in terms of their voting rights. While the basic premise of common shares is that they should have equal voting rights, one vote per share held. Some companies have dual or multiple classes of stock with different voting rights attached to each class. In such a dual class structure, Class A shares, for example, may have 10 votes per share, while the Class B subordinate voting shares may only have 1 vote per share. Dual or multiple class share structures are designed to enable the founders of a company to control its fortune, strategy, direction, and ability to innovate. Why companies issue shares? Today, corporate Giant had its start as a small private entity launched by a visionary founder a few decades ago. Think of Jack Ma incubating Alibaba from his apartment in Hangzhou, China in 1999. Or Mark Zuckerberg founding the earliest version of Facebook, now Meta, from his Harvard University dorm room in 2004. Technology giants like this have become among the biggest companies in the world within a couple of decades. However, growing such a frantic pace requires access to a massive amount of capital. In order to make that transition from an idea germinating in an entrepreneur's brain to an operating company, they need to lease an office or factory, hire employees, buy equipment and raw materials, and put in place sales and distribution network, among other things. Their resources require significant amount of capital depending on the scale and scope of the business startup. Raising capital. A startup can raise such capital either by selling shares, equity financing, or borrowing money, debt financing. Debt financing can be a problem for a startup because it may have a few assets to pledge for a loan, especially in sectors such as technology or biotechnology, where a firm has few tangible assets plus the interest on the loan would impose a financial burden in the early days when the company may have no revenues or earnings. Equity financing, therefore, is the preferred route for most startups and need capital. The entrepreneur may initially source funds from personal saving as well as friends and family to get the business off the ground. As the business expands and capital requirements become more substantial, and entrepreneur may turn to angel investors and venture capital firms. So for today's haul, give me a like please, and goodbye.